Our market master is Vineet Sambri. He's head of equities at DSP Investment Managers. He's joining us to take some questions. Vineet, great to have you with us here. The run continues. I mean, 8 weeks from the lows, and this is the ninth one. And, previous all-time highs are within grasp, within reach. You think they'll come fast, come quickly? How are you thinking about market levels now?
Yeah, hi, good morning, and thank you for having me on the show. So, I think clearly this rally surprised us as well. The last 2 months has been pretty strong, and I think when we look at in the corporate fundamentals, going through the first quarter numbers, I think broadly, the results have been pleasant, I would say, while we went into the result season with some bit of caution around the demand momentum. But I think across various categories, we are seeing that the demand seems to be pretty okay, despite the spiraling inflation. So I think that is the one part which I think has come out good. And the more important aspect is that, with most of these commodity inflation sort of tapering off, there is an expectation that as we head into the next few quarters, let's say third and fourth quarter, it will, things should be better off from the profitability front for the companies. Plus, the ensuing festival season should also uplift some bit of the demand momentum. So I think all in all, that has got factored into the markets level today. And the way to sort of think maybe from the levels perspective, I mean, there's no point in sort of predicting these levels, as we generally get caught on the wrong sides most times. But I think more importantly, the fundamentals seems pretty good right now. Most of the large segments, they seem to be sort of on a cyclical upswing. I mentioned about auto. Real estate is doing well. We saw the order book position of a lot of these engineering and capital good companies. I think they are at their all-time highs today, which is also a signal of a lot of activities which are happening and sort of likely to benefit these companies. So I think some of the larger segments, and banking, one of the largest, is actually started showing good credit growth. So all in all, I would say things are being on a cyclical upswing, which bodes well for the long-term outlook of the markets.
Okay, the stock of the moment is Whirlpool. Just look at that. It's just a breakaway gap, and then just building onto that. So it'll be interesting to see the top F&O gainer, and the market's been all about momentum of late. So just keep an eye on that for the rest of the day. Vineet, good morning. Consumption has come back in a massive way. In fact, it's a bit of a deja vu. Consumption and those financing the consumption are leading this run once again, which is what we had when the last bull market started, before IT took over. But your view on how some of these stocks have moved up, the consumption names, both discretionary and non-discretionary.
Right. So Anuj, I think between the discretionary and the non-discretionary, I would say that with the opening up of the economy, I think there is a good amount of uptick which we have seen across few categories within the discretionary. Largely, auto right now seems to be pretty resilient, and we were sort of anticipating some bit of cyclical uptick there. So that has come out well. But I would assume that when we look at the data points of most categories which are likely to be beneficiary of the opening up of the economy, people going out and spending, I mean, those are happening. The urban centers and the metro centers are doing well. But the one side, which is the rural and the entry level or the mass category, is struggling a bit right now, which to us also is most likely should come back as we see some of the rural outputs coming out better with good monsoons and good reservoir levels. So I think overall the consumption trend, we would like to believe or prefer the discretionary over the non-discretionary as of now. On the non-discretionary or the FMCG categories, I mean, for them also the bigger factor has been the inflation, which has actually impacted them. The volumes have been a bit low right now. But with a lot of their raw materials also actually the price inflation abating there, I think they should also sort of see some benefit over the next 2 or 3 quarters. But the valuations there are a bit punchy, which is what we would like to sort of focus more on the discretionary part as of now.
So when you say focus more on discretionary part, what are you looking at? What do you think the sector of the year could be from here on?
I mean, it's very difficult to call out sector of the year type of a concept, but I would say that, within discretionary, you have auto, which, we would sort of continue with our view about the cyclical upturn there. That's one, let's say, large category to think about. Then there are smaller, categories which should benefit, let's say, within the retail, I would say footwear, the food retail companies. I mean, these are the ones where we are optimist, and we hold them in the portfolios as well.
Okay. I wanted to also ask you about some spaces which had done exceptionally well, then had a big fall, and now are seeing a resumption. Midcap IT, for example. Of course, these companies are in different spaces. So, Tata Elxsi supplies to a lot of the EV guys. So, there is a special, uptick that they're seeing there in earnings, etc. But overall, midcap IT, is this the time to be buying? Is this the time to stay away?
So the way we are thinking, Sonia, is we are conceptually positive on the business outlook for the next, let's say, few years. Looking at how the digitization is happening, cloudification is happening, and most of the companies maybe are well aligned today in terms of their verticals, or the companies which customers they are catering to. So I think we definitely have a good long-term outlook. The only thing what we believe is that as we keep hearing more noise around the recession fear, the slowdown fear in the US and the European markets. I mean, these things are likely to, let's say, impact some bit of the growth expectation which these companies have over the next 2 or 3 quarters. And given the fact that the valuations anyways are, let's say, they have corrected down a bit, but still slightly expensive from their long-term averages, we would like to sort of stagger our investment into these over the next 2 or 3 quarters, as these noise around the recession fears and slowdown actually keeps impacting them, or they may go through some bit of correction or time correction, and that's the point to sort of look at these and gradually build the portfolios.
So for many of these, maybe a little lower levels, Vineet, that's what you're saying?
Yes, Prashant. That's the thought.
Okay. Sorry, you said you mentioned earlier footwear, right? As a space that you like?
Yes.
And could you just talk to us a little bit about, without naming names, what are you bullish about? Valuations again there, are they too high? Are they still reasonable? I mean, we don't have that many listed now. We've got a new one and a bunch of old ones.
So, actually, the industry has gone through, cyclical downturn because of COVID. We had school, colleges, offices all shut. And now, most of these institutions, as they open up, I think the demand momentum should also normalize. So, the category, it's a 80,000 crore market, and the companies here, they organized maybe 5 or 6 of them who are large, leading companies with good distribution, trying to do a good job in terms of the brand improvement, the positioning. I think these are the companies which I believe, and anyways, the footwear, overall usage pattern in India is improving. People wanting to have, footwear for different occasions. So I think, when we look at those aspects, we believe that the valuations on the current earnings may look slightly punchy, but the earnings itself has good potential to grow. The growth in the businesses itself can be high over the next 3 or 4 years, and which is where we believe that the higher valuations is something which one has to be careful about. But I think those are also justified given the kind of penetration opportunity and the overall growth option which is available in this category as such.
Okay, Vineet, the other space which sort of divides the street right now is metals. We've had a reasonable run from the lows, but a lot of this depends on how global things are playing out, the dollar and the cycle. As a fund manager, what's your view? Do you have a lot of metal stocks in your portfolios? If yes, how are you approaching the current cycle?
So metals, I am pretty underweight, let's say, in my portfolio. We have other managers who have some bit of exposure out there. In the long term, Anuj, what we have sort of seen is generally it's very difficult to predict the commodity cycle, and the best way to sort of play the metals has been when the stock actually corrects down to around zero point 0.6, zero point 0.7 book, and then you have to play through as the stocks actually head up beyond 1.5 book. So I think that's the range in which these stock needs to be sort of tactically traded upon, and I think that has worked well. Now, in the 2 months in the fall in the market 2 months back, I think the some of the stocks had corrected down to decent valuation. I mean, that was, let's say, a good point to tactically hold on. But right now, I think one can actually sort of wait. The news around the China economy, which is the largest consumer of metals, is also not coming out very strong. Most companies are looking to sort of show massive declines in their profitability over the next 2 or 3 quarters. So I think as these companies go through their own let's say volatility in price point, one should keep an eye on the valuations and sort of think of trading these metals as such.
Okay, one final question then, Vineet, because your mid-cap fund has done, of course, exceptionally well in the past. Wanted to ask you, is this a time to be venturing yet again into mid-caps? I know it's an unfair question because it's largely a bottom-up approach that one must look at, especially in volatile markets like this. But do you think mid-caps will outperform the large caps over the scope of the next, say, 12 to 18 months?
See, I would actually continue my view that overall, I think mid cap and small caps as a category, they are, they generally actually provide a good amount of, growth opportunities for investors with a long-term mindset. Most of the companies, they have, I mean, there are a lot of leading companies which actually don't find the large cap universe, let's say it is ceramic names or a lot of home improvement businesses, and agree as a category, and you find them in the mid cap or the small cap universe. So the only way to play some of these large opportunities which can grow multifold is available there. And I would sort of continue to hold my view that over a longer term, mid caps and small caps should generally outperform. One more important aspect which we have sort of observed in the last 2 years post COVID has been there is a massive consolidation which is taking place. Which is healthy for the large leading companies, the good brands. I mean, they are consolidating, they are gaining market share, and that only tells us that these companies are going to sort of show stronger growth over the next few years, maybe, and hence it's a good time to sort of think about mid caps, small caps as a category, have a decent weight in your portfolio depending upon the risk profile, and then continue to hold them for not 18 months but beyond 3-4 years. I think that's the way to play these categories.